Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Howard Morgan. He's the Chair and General Partner at B Capital, a multi-stage global investment firm that partners with entrepreneurs to shape the future through technology. Howard, it's great to have you with us. Welcome to Trade Talks.
Thanks, Jill. Great to be here.
All right. And the big question is, do you expect VC activity to pick up again in 2023?
Maybe at the end of 2023. I think it's going to be relatively quiet for the first half. In the summer, it might pick up a little bit, but in the fall, I think it'll pick up quite a lot more. It's one where everybody's been looking out for their existing companies and making sure that they're in good shape. Now that most of us have done that, we're starting to look at new players, but that's definitely something we're doing more slowly than we did before.
And what do you think is going to be the key to success for this type of companies to have a prolonged future and operate successfully?
Well, I think that we want to make sure all of our companies have 24 months of runway, cash runway. When I got into venture capital 40 years ago, Fred Edler had a sampler above his desk that said happiness is positive cash flow. We've lost that ethic over time in different places, but when you get the various cycles, bottoms, as we saw in 2000 and 2008, and we're seeing now, that slogan comes back into favor. And I think that's one thing that's key. And to making new investments, we want to be able to use this time to pick out the real gems and not fund things that are, when I say marginal, I don't mean they're marginal companies, but they're not as likely to become giant if they succeed. So we wait and bide our time a little bit until we get the really terrific ones.
Yeah. And Howard, to your point, we kind of go through this every 10, 15 years, and there's various reasons why, but it kind of comes back to, I think, a lot of human emotion. But do you think this will make the industry stronger, at least in the near term, with the lessons that were learned about management and profitability over perceived valuations?
I think we're clearly seeing the lessons about perceived valuations that got way too high. We're seeing that in the public markets as well as the private markets. When you value companies, take Tesla, for example, that is valued even now after its gigantic drop at $400,000 per car. Mercedes is valued at $10,000 per car. I mean, is Tesla worth 40 times per car what Mercedes is? Probably not, right? Is Mercedes worth 10? That's probably too low. But what we learn in these time periods is that there's a real, truly rational valuation. Psychology takes it way above where it should be, and then takes it way below where it should be in times like this. And so we've learned that trying to go towards companies that make real money on every transaction, positive gross margin, that grow their business in a measured way, not hyper growth where they're paying way too much for each new customer, is the way to create great businesses in these times.
Right. And what about the IPO market? Do you think we'll see a recovery too at the back half of the year?
I think the IPO market will take a little bit longer. I remember the 2008-9 situation very well. We took one company public in 2008 that was kind of at the very tail end of that. And it took till 2011 to recover basically to what it should have been valued at. There were no IPOs to speak of in 08 and very few in 09. So I don't think it really recovers until mid-24.
All right, Howard, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.